In today's episode, I'm going to walk you through how I was able to make over $500,000 in trading profits in just 7 days. My goal at the beginning of the year was to see how quickly I could grow my account over $1 million in trading profits. I did that in 51 days. So 51 days to make $1 million and then just 7 days to make another $500,000. What's the deal? I'm going to teach you how to put yourself in the mindset of being a successful trader, even if you're not there quite yet in terms of total profit. Because if you can think like a successful trader and you can act like a successful trader, that right there is half the battle. So let's go ahead and jump on the screen share. Here's the calendar. These were the 7 days. 7 days, $500,000 in trading profits. And for every one of these days, I upload my recap right here on YouTube. You know, I'm probably one of the only traders out there that does a recap every single day. But what's really important about that is I don't hide the red days. I show them to you. So let's begin this episode with some transparency. Trading is risky. My results aren't typical. I've been doing this for a long time, but we're going to talk about risk. And I'm going to walk you through the steps that I take to reduce my risk when I'm trading, even when I'm trading with very large amounts of money, as you can see right here. So during this challenge, this 7-day window, I had 69.3% accuracy, and I took a total of 166 trades. So in other words, I was right on 115 of them, and I was wrong on about 50 of them. Losses happen, and I'm not afraid of losing because I know that as long as I keep my losses smaller than my winners, and I can maintain accuracy greater than 50%, that statistically, I will be a profitable trader. So those statistics give me confidence. And this is probably one of the most important things that I have that give me an advantage right now. What you're looking at, it's my trading history. That trading history is my knowledge that over the long haul, and I'll show you as we get further into this class, over $17.5 million of my trading data in these reports. It tells me that what I do works far more often than it doesn't. So as long as I stick to the rules of my strategy, the statistics are going to produce the profit. The profit really is a byproduct of following the rules. I'm going to share those rules of my strategy with you here today. So there you go, 69.3% accuracy, but let's look at that relationship between the average winners and the average losers. You can see the average winners during this 7-day period were $5,687. My average winners. My average losers were $2,937. So that gave me a profit to loss ratio of just about 2 to 1, not quite. So we know day trading is risky, but we can put the odds of success in our favor by understanding statistics. So what do we have here? This is a table that compares your risk, your reward, and what your break-even accuracy percentage would be based on the risk-reward relationship. So if you win $1 and you risk $1, so you've got a 1-to-1 ratio, your accuracy only needs to be 50% to break even. And that's fairly intuitive. It's like a coin toss. However, if you risk $1 to make $2 and you've got a perfect 2-to-1 profit to loss ratio, you only need to be right 33% of the time in order to break even. And this is where you're putting the odds in your favor. Because think about this. As a beginner trader, you don't have the benefit that I have of all of this educated intuition. Educated intuition comes with experience. I funded my first trading account in 2001. That's nearly 25 years ago. So I've got a lot of experience in the market. I've been through a lot of ups, I've been through a lot of downs, and all of those experiences have given me the intuition that helps me know that I should punch it right now on the buy button, or that I should get out right now, or that this is a stock that has the potential to do more than just a little move, but it could really do something exciting. Now, for those of you guys tuning into this channel, perhaps for the first time, let me introduce myself. My name is Ross Cameron. I'm a full-time trader, and one of the things that I love to do is to share the strategies that I trade every single day with those of you guys on YouTube and for members over at Warrior Trading. Through my career, I've been fortunate enough to be able to invest the profit that I've made into building custom software called Day Trade Dash. Day Trade Dash is what I call the ultimate day trading dashboard. It's a piece of software for scanning, charting, breaking news. It includes our chat rooms, my live audio video broadcasts, and we're continuing to build on it today. So as we go through today's episode, you'll see me demonstrating some of the trades and showing you some of these screenshots, and those are all straight out of the Day Trade Dash platform. So for those of you guys who are brand new, I hope you subscribe to the channel. And for those of you guys coming back, I hope you hit that thumbs up because we are about to jump into a deep dive, full training episode. So as a beginner trader, you don't have the benefit of educated intuition. So having a lower break-even minimum is going to be easier. If your break-even's 33%, you're setting the bar a lot lower to be successful. But you know what happens for a lot of beginner traders? Well, they end up with an inverted profit to loss ratio where they lose more on their losers than they make on their winners. Why does this happen? It happens because of fear. And the fear comes from a place of financial scarcity, that you're not confident with your financial condition and with the profit that you've made trading. And so it makes you more hesitant. So let me give you an example. You get into a trade, it goes up a little bit, and you're afraid that that small winner is going to disappear. So what do? You sell it. As soon as it's up a little bit, you sell it. Maybe it's a $50 winner, maybe it's a $100 winner. But then the next trade you take, you get in and you're instantly down 50 or $100. Do you sell? No. Why? Because you're afraid of the loss. Shouldn't that make you sell even faster? It doesn't, because what happens is you tell yourself there's still a chance that this will turn around. So I'm going to keep holding it. I'm going to hope that it turns around. Next thing you know, you're down 200, 400, 600, 800, 1,000. You finally sell it for a $1,000 loss, and now you're a trader with an inverted profit loss ratio. You make $50 on your winners, you lose $500 to $1,000 on your losers, and you would need to be right 90% of the time or higher in order to just be break even. Now, that's not realistic. I'm not right 90% of the time, and I've been doing this for forever. So it's not realistic as a beginner trader to trade like that, but that's exactly what a lot of beginners do. And it's just simply because they don't know. So what I'm going to do today is I'm going to empower you with this knowledge of how to stack the odds in your favor. Now, we cannot control how much we will make on a trade, but we can control how much we're willing to risk. So something that I've said for a long time is that if you take a trade, you jump in and you haven't already calculated what your risk is, that's not trading, that's gambling. You're just throwing money on something and hoping it goes up, but not thinking about what happens if it goes down. So it becomes a trade when you've calculated your risk versus your reward. And once you've done that calculation and you understand that you stand to gain more than you stand to lose, then that's a trade worth taking. Okay, so profit loss ratios are very important. But again, what happens to a lot of beginner traders is they don't fully understand how risk in the market works. So for instance, I might have a trade, and this is an example of a trade that I took just yesterday, actually, where I made over $100,000. Now, some people, and on this position, I actually had to put over $100,000 into the trade, which means I was buying more than $100,000 worth of stock. And some people would say, Ross, you're risking 100 grand on this trade. Now, in this case, I made 100,000, so you could argue that that's a 2-to-1 profit to loss ratio, or a 1-to-1. But when I put $100,000 into a trade, I'm not risking 100,000. So let me clarify what it means when I'm talking about risk. I'm talking about the difference between your entry point and your max loss. So when we get zoomed in on this area right here, what we have is a chart pattern that I love trading. Now, to give you context, this stock was the leading percentage gainer in the entire market. So it was already up several 100%. It was an energy stock. All energy stocks in the whole energy sector were going up. This had squeezed higher. It pulled back, and I was looking for the first candle to make a new high. So my entry, which was right here, as soon as that candle broke the high of this red candle right here, I got in on this green candle, I bought, and what was my max loss on the trade? My max loss was right down here. So if I bought $100,000 of stock, let's just say to keep the numbers round to make it simple, the only way I'd be risking $100,000 is if I was willing to hold the stock until it went to what? 0. And I'm not going to hold the stock until it goes to 0. I now own something of value. So the $100,000 that I'm putting into this trade, the majority of it is really just a tool that gives me the ability to profit and participate in this move. What I'm actually risking is the difference between my entry price and the price that I would sell for at a loss. And so in this case, let's say I got in at $8 and my max loss was $7.90. Let's just say, for example, I could be risking with 10,000 shares, $1,000. So that would be, in that example, an $80,000 position. I'll just draw it out on the whiteboard here. So $8 a share times 10,000 shares equals $80,000. And then 790 times 10,000 shares equals $79,000. So if I sold it at 790, I'd get back my 79,000 and I'd have a loss on the trade of $1,000. Simple as that, right? So when people are talking about risk, it's important to understand the difference between the capital that you're putting into a position and the total risk, which is the difference between your entry right here and your max loss. Now, there's no doubt about it. In order to take $80,000 of stock, you would need that buying power in your account. So if you have a small account with $50 or $100, then all of these share sizes are going to be obviously significantly smaller. And to be frank, if you're trying to day trade with $50 or $100, you're going to find it difficult, because how much money can you make on a really good day? Maybe on a really, really good day in the market, on a stock like this, maybe you could double your money, getting in at 4 and selling at 8, getting in at 5 and selling at 10. Maybe you could double. So a $50 account going up to $100, or a $100 account going up to $200. But that would be putting your entire account into that one trade and trying to double. It's just that doesn't feel reasonable. So I'll also be honest with you that having more money is an advantage. Although you shouldn't think that it's a guarantee that you'll be successful, because there's traders that come to the table with money, but they've got no skill, they've got no strategy, they're gambling with their account. And there are other traders that come into the market with $500 and they start taking 1 share, 10 shares, 20 shares, 40 shares, and they slowly grow that account, proving consistency over the course of weeks and months. And in fact, that's a really great way to start. But you know what? If you could start with a $2,000 account, a $3,000 account, maybe a $5,000 account, it would be a little bit easier. You'd have more buying power, and that would mean on a day where, a stock like this goes up 400%, even if you can't capture the entire move, but you can capture a small sliver of it, that's where you can get some really nice account growth that produces meaningful profit. Because one of the challenges with trading in a small account is, can you be content with making only $6, $8, $10, $15 in a day? Some people can do that and others can't do that. So if you have a goal of making a bit more each day, you've got to think about how you can come to the table with more money at the beginning of your career. Something to think about, food for thought. There's no right way. It's really whatever way works best for you. So this is just sort of a brief explanation of the way I think about risk in trading. Now, when I think about profitability in trading, I break it down into 3 core components. Your first is your profit to loss ratio, which we've already discussed. Your second is your accuracy. And then the third is your consistency. So if you're right now trading and you're not making money, you're losing. You're losing money, you're struggling, you're frustrated. You might ask a trader like myself, where do I start? How do I turn this around? I'm not consistent. My accuracy is low. My losers are bigger than my winners. I don't even know where to begin. So I'm going to tell you exactly where to begin to put yourself into a positive feedback loop. And I'm going to walk you through it by showing you what happens to most beginner traders. Most beginner traders fund an account, and what do? They take their first trades and they lose money. By losing money, they immediately create a sense of despair, disappointment, frustration. And what do they do in this moment? When they're feeling angry, frustrated, and disappointed, they don't want to feel that way anymore. So what's the fastest way to alleviate that feeling? It's to make back the money you just lost. So now what are they going to do? They're going to increase the number of trades they're taking. However, this trader does not yet have a track record. They don't have experience. They don't know what they're doing. And so the result is that they're going to lose more money. So now they're going to lose double money. And they're going to feel even more frustrated. And it's going to lead them to take even more trades. And you see where we're going. This is a downward spiral. Okay, well, everyone who starts trading ultimately comes to the table with no experience. So we all start in the same place. And yet, some people make their way from beginner all the way to experienced and profitable, while others, well, they do this. So what's the difference? All right, I'm going to share with you exactly what the difference is. The difference is that the right way to learn is to start in a simulator. You start by trading in a stock market simulator where you're not risking real money. So you have the account, let's just say it's $5,000, but it's pretend money. So now you've got money, but there's not emotion on the line. You take those first trades, you lose, right? So you lose money. Okay. You're sad. And this, even if it forces you to take more trades, you're going to realize very quickly, okay, well, that doesn't work. Fortunately, this was not real money. So you press the reset button, reset your account back to $5,000. You learned a lesson there. You learned a valuable lesson, but it actually didn't cost you a penny. So you're not emotionally hijacked. So you set the account again and you realize, okay, what if I approach this differently? What if I focus here just on A+ quality setups? I'm going to walk you through what A quality setups look like in today's class. By trading A quality setups, focusing on the quality of the setup, not on the profit, you focus on A quality setups, what's going to happen? Your accuracy, your percentage of success is going to increase, which means the number of losers you have decreases and your average profit loss ratio will also increase. And that's where you begin producing a track record of consistency. Maybe it's only a couple dollars of profit, but you keep doing that. You feel more confident, you do it more, and next thing you know, you're growing your account. This is the positive feedback loop. And it all begins right here with accuracy, focusing on building a strong track record. So high accuracy stocks improves your profit loss ratio, which then improves your consistency, gives you a sense of confidence. And with that track record, even if it's in the simulator, that track record is what you base your conviction on, that you know what you're doing. So now you increase the number of trades you're taking, you gain more experience, you have increased profitability, and this is where you then say, all right, I've been doing this in the simulator for 6 weeks, for 2 months, for 3 months. I'm ready to go ahead and fund a real money account. I'm going to fund my real money account, and let's just say you fund it with $5,000. Maybe it's more, maybe it's less, doesn't matter. But you now are coming to the table with something that first trader didn't have. You now have a track record. And so you now know that as long as you focus on A quality setups over the long haul, your statistics will reward you. You just have to follow the rules. Okay, so let's start getting into what my daily routine looks like each morning. I'm going to start by walking you through my pre-trading routine. My pre-trading routine is kind of the first, the first thing that I do each day. And I'll tell you that trading is hard enough without losing due to unforced errors. What do I mean by an unforced error? Well, let's say, for example, you're trading and all of a sudden your computer crashes and you lose money. That feels like look, that happens, but if it's as a result of your computer crashed because it's not running well, because you haven't been doing virus scanning, or because you've got too many platforms running at the same time, then that was an avoidable mistake, right? For instance, losing money because you pressed the wrong button. These are avoidable mistakes. They will happen occasionally, but we want to avoid and minimize them as much as we can because trading is hard enough. So the first thing I do each day is an equipment check. My equipment is pretty simple. I've got my computer and I've got my external monitors. That's about it. It's nothing that fancy. So for a long time, I traded just on a laptop, regular laptop. I'm not using an external mouse, just regular laptop, using the trackpad for my mouse. And that was all I needed. And whenever I travel, that's all I bring with me, my laptop. And then I bring 2 USB monitors. Now, the USB monitors that I bring with me are, they're made by Asus. They're super skinny, as you can see here. I like these. They're not that expensive. Obviously, I'm not sponsored by Asus. I just think they're decent monitors. This one I've had since 2018, so it's 7 years old, and it's fine. It works great. So when I'm traveling, I use these monitors right here. When I'm at home, I've got 24-inch monitors that I'm using. And so the first check for me is just checking my equipment each morning and making sure everything is looking good. So if you think about, in a way, your pre-trading routine, your pre-trading checklist being kind of like a pilot. You're checking the airplane, right? Just do your checks. So I want to check my equipment. I usually want to make sure I've restarted my computer, not necessarily every day, but certainly every couple days, just to make sure it's running at its best, clear the memory, make sure you're not overloading anything, shut your browser, shut apps you're not using. Focus this on being your work machine. You're going to use it to try to extract profit from the market, and you don't need it screwing up on you. So do your equipment check. Next, do your internet speed check. Now you could go to fast.com. Fast.com is powered by Netflix. It'll tell you your internet speed. I like to use a different one, which is speedtest.net. And the thing that I like to look at is my ping. That's the latency in my internet. So for instance, I'm pretty close to New York City. So I don't have a lot of latency from my house here to, skyscrapers down in New York City. So my ping is probably 9 milliseconds here like this. Is it milliseconds or is it even, it's 9 ms. However, if I go over to, let's say I go to Rome, over here I go to Italy, my ping to New York City is going to be more like 112. Now, if I go all the way to Australia over here, my ping to New York City is probably 225. Now, if you do a ping test and you're in the United States and your ping is showing at 500, then there's something wrong with your internet. So I like to just check my internet just to make sure that not only is my speed adequate, but that my ping to New York City, which is where the data centers are, is also fast. Because if I have latency, then my orders are going to go behind what I think is real time, and that's not going to be acceptable. So I want to make sure that I've got fast internet and I've got a low ping. Now, I'll be honest, I've traded on my Starlink satellite internet, I've traded on my mobile hotspot, and I've done those in the United States, and I've not had a problem with it. However, it's good to know what your ping is so you understand if you're really in sync with real-time data or if you're slightly lagged behind. Number 3, power and weather check. I don't want to worry about losing my power in the middle of a trade. Now, one of the things that I do at home is I plug my modem and my computer into an uninterrupted battery. So it's an uninterrupted power supply. So if I lose power, I will still have power on the battery for a period of time. That is enough time for me to close a position that I'm in before everything turns off. But I'll give you an example. When I was living up in Vermont, when I was first trading, I had a day where I took a trade and all of a sudden, it must have been like a tree that fell across the power line. So my power went out, but what also went out was my internet. They were both gone at the same time. And there was no cell service where I lived in Vermont. So all of a sudden, I'm completely offline. My phone's out, my internet's out, everything's gone, power's out, and I'm in a position. What do? I have to get in my car. I have to drive 15 minutes down the road to where I get cell service so I can call my broker and ask them to get me out of the position. That's not a good situation to be in. You need to have a backup. So whatever I lost, I don't even remember what the net result was, but it obviously wasn't significant enough that I remember it. So probably nothing big. But if you had a big loss as a result of something like that, it would feel like that was an unforced error. Yes, there's bad luck, you'll lose power, whatever, but prepare yourself for when this happens. Now, next you've got your software check. No, this is the software you're going to be using for trading. Some platforms are historically, and noted to be buggy, and traders struggle with it. And other platforms are much more reliable. You'll obviously be better off using more reliable software, but if you're in a community with other traders, you can always just get feedback right away and notice, are people saying there's issues with this platform today, or is everything good? So these are important checks to do. And then you've got your personal checklist. Did you eat well? Did you sleep well? How's my patience today? And am I coming to the table at 100% capacity? Sleep, for me, is one of the most important things. If I don't sleep well, I am not at 100%. And I know that's tough, especially for traders on the West Coast who have to get up early. I get it. It is tough, but sleep is important. Sleeping well helps you make better decisions in the heat of the moment. It gives you more patience. It gives you more discipline. Sleep is like, for me, it's like the mental fuel that I need. Now, of course, food is, fuel too, but really sleep is the most important fuel. I need to be full on sleep in order to make good decisions each day trading. So being at 100% is important. Now, if you think of trading as kind of like a performance sport, think of it like basketball, tennis, doesn't matter what sport, but you're coming to the court and you want to be at 100%. You want to trade your best. You want to extract profit from the market. You do not want to make unnecessary mistakes. You want to try to make all of the right decisions in the moment when it counts. Will you have losses? Sure. Are you going to shoot hoops and you're going to miss a couple? Sure. It's not about never missing. Losses happen. It's okay. But it's about bouncing back quickly, keeping those losses tight, not getting rattled. Have you ever watched a game where sort of at the end of the fourth quarter, whatever it is, all of a sudden the team totally unravels? They start getting desperate. They start sort of flailing and just the whole thing falls apart. It's embarrassing to watch. You don't want that to happen when you're trading because the cost can be significant. So this is my pre-trading routine that I go through each morning. And it's very quick, to be honest. It takes less than a minute. I just quickly check my equipment, check my internet, ask myself if there's a big weather issue or something that could threaten my power. My software check, I use software that's consistent, so I don't worry about that. And then my personal checklist, as long as I slept well the night before, I'm usually fine. And in terms of eating well, because I begin trading so early, I often don't eat before I start trading, so it's not really a factor. But if you're trading in Europe, and you don't start trading till, let's say, 1 p.m, then this is a consideration. Have you drank 10 cups of espresso? Have you been drinking alcohol? Because all of these things are going to affect your ability to be at 100% capacity, right? So time zone is a factor there when it comes to eating and sleeping. All right, number 2, my stock scanning criteria. So how do I find the stocks that will be the leading percentage gainers in the entire market today? Now, I'm not saying that are right now, but that will be. This is really tricky. This is finding a needle in the haystack. It really is. And a lot of traders ask me, Ross, how is it that you're so consistent finding these big movers every single day? And I'm going to tell you, to be honest, finding them is not really the hard part. I'm going to share with you my scanner criteria, and you'll be able to use that criteria and find them just the same as me. The more difficult part is actually finding the right entries and, of course, keeping your losses tight. But let's go ahead and get into these criteria that I'm using. So what will be the top leading percentage gainers in the market? Well, I'm going to pull out something that, like I said before, is probably the most valuable thing that I have. Not just because it's $17.5 million, but because this represents more than a decade of trading. This is me trading every single day. These are thousands of trades. Right here, we've got 32,000 trades spanning more than 10 years. I have maintained accuracy of 68.5%, trading the strategy that I'm going to be teaching you guys today. Now you can see that over the long haul, my profit loss ratio is about 1-to-1. $1,400 losers, $1,400 winners, $1,300 losers. This is in part because a period in my career where I had an inverted profit loss ratio, and it simply takes time to recover from that. So my profit loss ratio this year is actually the best it's ever been, which goes to show that even after all of this experience, I'm still improving as a trader. But from this data, I can tell you exactly the type of stocks that I make money on, and then we're going to program that into our scanners. So it begins with stocks that are trading on 5 times above average volume. So all of that profit, $17.5 million, when you distribute it based on the relative volume of the stock I'm trading, 90% of it, nearly 90% of it, is on stocks with 500 times higher, which is 5 times, higher volume than its 50-day average. Think about that for a second. Let that sink in. So nearly all of the profit comes from trading stocks that have 5 times higher volume on the day I'm trading it than its 50-day average. Most of the profit comes from stocks that have at least 10 million shares of volume, and I make more as the stocks have more volume. So this is now starting to paint a picture. You've got stocks with 5 times higher volume than their 50-day average, and they've got more than 10 million shares of volume today. And these are stocks that are generally gapping up. What does it mean for a stock to be gapping up? It means it's currently trading higher than it closed in the previous session. So gaps are created by after hours and pre-market trading. So for those of you guys that aren't familiar, the market opens at 4 a.m. and closes at 8 p.m. This is the full day, but 9:30 to 4 p.m. are regular trading hours. So when a stock closes the day at $5, and then let's just say after hours squeezes up to 750, then the next morning when it's at 750, it's going to show as gapping plus 50%. It's gapping up 50%, right? Now, if by the time we get to 9:30, it's at $10 a share, $10 a share, then it's actually going to be gapping up by that time 100%. It'll be up 100%, plus 100%. So basically what you see here is that the majority of the stocks that I'm trading have 5 times higher volume today than their 50-day average, have more than 10 million shares of volume, and that is 5 times higher than its average. So on average, they trade light volume, but then suddenly they've got high volume, and they're gapping up more than 10%. Why would all this happen? It's because the stock has news. So my strategy revolves around trading stocks with news. Generally, it's news that creates these moves. Now, there are some rare exceptions to that, where a stock will be strong and it's not based on news. It's just there's maybe a technical setup, or maybe stocks in a similar sector are also strong, so it's sector-wide strength. Or sometimes the catalyst is a little bit more obscure, like there's high levels of short interest and shorts are getting squeezed out. But generally, to keep things simple, I'm trading stocks that have breaking news. Okay, next. I found that trading stocks between $2 and $20 offer larger percentage returns for account growth. And so you could see when you look at my profitability based on the price of the stock, I make the most money right here on stocks between 2 and 20. Now, yes, I've traded some higher price stocks, GameStop, a few other stocks that got more expensive, and I've traded some lower price stocks. However, this for me is really the sweet spot between 2 and 20. All right, so this is gonna be another criteria that we're gonna scan the market for. So we know we're gonna look in the market for stocks that have 5 times higher volume today, that are up. Let's start writing it down. So 5 times higher volume today, 5 times above average volume are, what was the second one? 10, we could do 10 million shares of volume and higher, has a 10% gap, is priced between 2 and 20. So right now we've got 4 criteria that we can program a stock scanner to search the entire market for this. And if we search the entire market for this, how many stocks do you think we would find on a typical day? Well, there's nearly 10,000 different stocks, ETFs, and funds that you could invest in and trade. So out of 10,000, how many do you think we would actually find? On a typical day, it's going to be less than 30. Less than 30. So all of a sudden, we're finding the needle in the haystack real quick. We've gone from 10,000 to 30. So now we've narrowed it down. But there's a little bit more that we can do. So what I also learned is that I make more money when the stocks have a float of under 10 million shares. These are stocks that have bigger imbalances between supply and demand. What does that mean? Well, when a company does its initial public offering, they sell shares onto the open market. So let's say they sell 10 million shares onto the open market. They sell those shares at $5 a share. The company raises $50 million in their IPO. They use that money to reinvest in the company grows, But if you want to buy shares of that company, how many shares could you buy if you wanted to buy every single share that was out there? There's only 10 million. So now imagine, for instance, that company puts out news that they've got a partnership with Tesla. Maybe Tesla's invested a 10% stake in the company, let's just say. All of a sudden, people are going to be starting to think, whoa, Tesla might buy this entire company. This is such a huge contract. This is such a huge deal for a small company. I want to get a piece of that. And all of a sudden, in a day, the price of that stock could go from 5 to 10 to 15 to 20, maybe higher. We've seen it happen. But what we notice is that while the news creates demand, you need an imbalance between supply and demand to see a big move in price. And so, let me go back to full screen on this. So when we look at this chart, I'm going to show you a chart right here. This is a stock that went up over 432%. It did it on 300 million shares of volume. It was a low float stock. In fact, the total number of shares available were less than 1 million. And that's kind of hard to get your mind around because you're like, wait a second, there's only 1 million shares available, but it traded 300 million shares in one day. That means people were buying, selling, buying, selling, buying, selling so rapidly. When it was up 100%, everyone that was probably holding from the previous day sold. They're like, wow, this is awesome. We're just going to sell for 100% winner. But there was a new round of buyers that were already ready to buy up those shares for the next leg up. And then it kept going higher. And then those people sold. And then new people bought. And then those people sold, new people bought. And it kept cycling again and again and again. So what you had is very limited level of supply and a very high level of demand. And that's what creates these rapid rates of change. This is volatility, and this is where I make the most money. So the 5 criteria of stock selection that I use every single day are right here. We want to see the stock up 10%, the 5 times relative volume. We'd like to see that there's a news event. Most traders prefer stocks priced between $2 and $20. They're more affordable, and we get the bigger rates of change. And then number 5, we want to see the supply of less than 10 million shares available to trade. Now, if a stock meets all of these criteria, but right now, let's just say, for instance, only has 2 million shares of volume, I could probably make a prediction that if the stock is already up 10, 15, 20%, that more volume is going to come into the stock as the day goes on, that people are going to keep trading it. Maybe right now it's the second leading gapper, but the leading gapper has a larger float. There's a good chance that this stock will become the leading percentage gainer. So it is my educated intuition that helps me make that call in real time. Now, when it comes to when I sit down each day, that's also very clear in my data. I make the most money in the first few hours of the trading day, currently from about 7 a.m. until about 11 a.m. This is, again, $17.5 million of profit, and this is how it's distributed. So if you said, Ross, you could only trade from 3 p.m. to 4 p.m., that would be a little bit tricky for me. Now, I think if that was the window and that was when I was starting each day, I would adapt my strategy and I would make it work. But right now, that would be leaving a ton of money on the table because the most volatile time in the day is the open. Why is that? Well, that's when the companies are putting out breaking news. They put out that breaking news early in the day, and they do that from self-interest. They want traders and investors to see that news headline and to buy up shares of their company. They want to see the share price of their company go up. They have a fiduciary obligation to all of their shareholders. So they're thinking strategically about when to put out news headlines. In fact, there's a correlation based on day of the week. Companies are more likely to put out good news early in the week, more likely to put out bad news at the end of the week. All right? So these are the patterns and the trends that I've learned from all of my years of trading. And I'm more than happy to share them with you. Sharing them with you doesn't make them work any less for me. There is so much volume in these markets. There's so much opportunity in these markets. I have no problem with there being more traders in the market. In fact, if anything, more traders increases the liquidity in the market. We saw during the pandemic when all of these traders came into the market, these surges of volatility. It was truly incredible. It was unbelievable. And GameStop was sort of the pinnacle. I mean, on GameStop, you could buy millions of dollars of stock and get in and out in an instant. I mean, there were people that made hundreds of millions of dollars actively trading these stocks. People that made far more than I'll ever make. They had more money at the beginning and they took more risk. They were comfortable doing it and they got rewarded. Regardless of where you are in your journey, maybe you trade with 1/10 of my share size. Maybe you trade with 1/100th of my share size. We're all somewhere on the spectrum, and there's only one person out there who's ever going to be the most profitable. That's not going to be me. It's probably not going to be any of you. And there's only one person out there who'll be the biggest loser, and everyone else is just somewhere in between. And so we've got to not compare ourselves to others, but be grateful for what we're able to do each morning, but also ask ourselves at the end of each day, what can I do to be a little bit better? So my day begins about 7 a.m. And this is the strategy that I focus on each day. Here's the question. What is the best way to profit from the leading percentage gainer? how do I buy a stock that's already up 25, 30%, or maybe more? That's the real question, and I'm going to answer it. I manage risk by step 1, only trading the right stocks each day. That means if the stocks don't meet my 5 pillars of stock selection, I should not trade them. And I further manage risk, reducing my downside loss by only trading the right chart patterns each day. So this gets into the language of technical analysis. Now, what I'm going to do for all of you guys here today is I'm going to give you a link where you can download my trading plan worksheet. It's going to go through a lot of what we talk about in today's class. It's going to document it so you can print it out. You can keep it side by side, at your desk while you're trading. And it's also going to expand in a bit more detail than I have time for in today's episode. So with the trading plan PDF, there's a couple other PDFs that I'll include for you guys that you can download. And you can print them out. You can use them in your trading. They'll help you with your stock selection. I've got my small account challenge worksheet in there, and then this trading plan. I think you guys will really enjoy it. So there'll be a link pinned to the top comment and posted also in the description of this episode where you can download this worksheet. So this is the way I approach a stock. We've got a stock that hits our scanners. Okay, so let's just say, big picture, we're going to take a step back. This is our scanner right here. This is Day Trade Dash, the software that I use every day. And this is our scanner right now that is giving us our leading percentage gainer. And it's RBNE. It's up over 300%. It's got over 100 million shares of volume. And I finished the day up over $100,000. Wow, a crazy day. So this stock right here, well, the scanner pointed out to me. It was easy to find. It was right here on the scanners. So this is my top gainer scanner. Now, I have this second scanner here called my small cap high-day momentum scanner. And you see the bell here. It's got an audio alert turned on. So if I go back to the very beginning of the day, I have to scroll all the way back here. We go back to 6:30 in the morning, 7 in the morning. That's when you'll see this stock first came up on my radar. So when I started building out this software with a team of developers back in 2017, initially we built it out as our chat room, and it's got my broadcast in it, and then we added our scans and the news and the charts and everything else. What I said is, I want to find these stocks in real time. The moment they're meeting my criteria, I want to know about it. And I want to get an audio notification. So what we're doing is we're subscribing to market data for every stock in the entire market, but we're filtering it. We're looking for very specific conditions. And so I've programmed these scanners from all of my trading data to search for the type of stocks I make the most money on. So right here at the beginning of the day, RBNE hit the scanner here at $6.47. At the time, it had 1.5 million shares of volume. Volume was a little light. It wasn't quite 10 million yet. The float, the number of shares available to trade, was 1 million. It was already up 93% on the day. It was gapping up, as you can see right here. Now, it had a catalyst. Everything on this stock lined up. The relative daily volume, which has to be at least 5, was 9,000. This is the daily chart of the stock. This was the highest volume day it has ever had in its history. This is a stock that only became listed on the exchange a couple months ago. So it's a relatively new stock. It initially popped up, it sold off, and then all of a sudden here, with a catalyst, with news, squeezes up 300-400%, makes a huge move. So I ended up taking my first trade on it very early on. So I found the stock using those 5 pillars of stock selection. Once I found the stock, now I'm doing my technical analysis. I'm pulling up the chart. And so this is what we're going to look at here. All of a sudden, the stock hits the scanner. So boom, 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 we're getting the audio alert. We're hearing it on the scanner right here. RBNE, ding, 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 ding. So it's on the scanner. I pull up the chart. I already know I like the stock based on the 5 pillars. Otherwise, it wouldn't be on the scanner in the first place. And I see it squeezing up. What do? Do I get in right here? The stock meets all 5 pillars of stock selection. I should just buy it right here. Now, this is where I've got to be patient. It's hard to watch it squeeze up without me, but I've got to be patient because what I know is that stocks never go straight up. They don't just go, for instance, like this. That's not the way the market works. What happens is we sort of have these waves of momentum. So right now we're experiencing our first wave up. And that's taking the form of big green candle. Maybe a couple big green candles, maybe 3 or 4. That's all right. We know that we will get a pullback. We'll get a pullback because there will be people who were in from before that decide to take some profit. This is where I'm going to pay close attention. So here's the idea behind my strategy. I am a momentum trader. So I look for stocks experiencing momentum, trending up. The more they're trending, the better I do. Now, I could trade Bank of America. I could trade slower moving stocks. They trend, but they don't move up that much. So let's just say you've got a small account. You've got a $5,000 account. You buy Bank of America at $10 a share. It goes from 10 to what? 10.01, 10.02. Maybe over the course of the entire day, it goes to 10.15. These moves in percentages are so tiny, you can't make any money. 1% of a $5,000 account, it's just not enough. It's not enough to be worth your time to sit here every day. And you could never really scale that strategy until you could buy huge amounts of shares, which you wouldn't be able to do without making a lot of money. So it never really happened. But then you've got a stock like this. Well, let's say this is RBNE from right on the scans that goes up 300%. So 300%, well, wait a second. So you're saying this first leg is 100%. So now it's dipping down here. So now I buy 5,000 shares down here, and all of a sudden, boom, whoa, or $5,000 worth, and it goes up from $8 to $12. Wow. So I'm up 2,500 on that trade. Now that's what a retail trader is going to be more interested in. Where I focus on trading these is watching the points where they're changing direction. So when it's changing from going up to going down right here, and when it's changing from going down to going back up. So how do I understand that change, that shift that occurs, the waves from rolling back to going back up? What I look for is this relationship right here. So let's zoom that in on the screen share. We got our first candle that goes red. So if I was already in this position, this is where I would sell. This would be my exit indicator. I've got my first red candle. I should take my profit off the table. The second candle goes lower. So I'm already out. I wait. Okay, here we go. Well, what was that? First candle to make a new high right there. Now that is the trend shifting. So now all of a sudden we're shifting. So that right there, this green candle is my entry. When do I buy exactly? I buy the moment this green candle broke the top of this candle. So let's say that line right there is $3. Let's just say $3. Just make it simple. So it's $3. So I'm going to buy right here at 3. And you know what? If I get filled at 301 or 302, that's fine. I don't mind getting in a little higher. If I got in at 299, the risk with doing that is that the candle hasn't broken yet, and it could end up being a false breakout where it looks like it's going to break, but then it goes back down and drops lower. Now, as you gain more experience and you get more educated intuition, there will be times that you go ahead and get in at 298 or 299 to anticipate that it's going to break through this level. And there'll be other times you know that you better wait for confirmation. So this is the setup right here. It's a bullish pullback. So we've got the squeeze up. It's now pulling back. And what's important here is that we buy the first candle to make a new high. Our target is a retest of our high of day right there. And then we want to see it continue through that level even higher. So what ends up happening is in real time, we have a stock that hits our scanners, like this one right here, just for instance. Hits the scanner, pops up, one green candle, second green candle. We're being patient, we're waiting, we're letting it dip. It dips down. First candle to make a new high, that's the entry, that's the profit. And we're taking our profit off the table in two ways. One is selling when we get a red candle, when it closes red. And the second is by selling half the position as we're gaining some profit, just to pay ourselves. That's the more conservative approach, to take a little profit off the table before it potentially disappears. So I'm going to give you a pop quiz. Okay. As you look at this right here, UPXI, is this a setup that would be worth considering? Now, I'll tell you that there's a couple things about it that you might have to be a little bit more cautious about, but let's just look strictly at the candlestick chart. Based on the candlestick chart right now, we've got high volume on these three candles that popped up, one red candle, a second red candle. This is going to be the first pullback on a stock that just squeezed up. And so the answer is that this is a place that I would be a buyer. And there you get that nice resolution as that first candle makes a new high and the second one pushes higher. Now, one of the challenges with this one is that the gap is 28%. So we would have to check to see if there are other stocks that are more obvious. However, you can see the float is less than 1 million shares, so it's a very minimal level of supply, but the total volume is also quite light. So ultimately, this would require us to evaluate the strength of the catalyst. What is the news event that this stock is experiencing? If it's strong news, this could work really well. And in fact, this one was really strong news and it kept going up pretty much all day. All right, here's another example. First candle to make a new high. So we have this sort of slow rally. Now this can be an area where, sort of similar to Bank of America, it's moving, but it's not really moving up that quickly. And so this can be, for me, an area where I don't really want to trade because the total profit on these moves is just not enough to really justify the risk. I feel like I can't get a good 2-to-1 ratio. But then when suddenly we get a 20% squeeze like we did right there, as this goes from 560 up to 880 nearly, then it dips down here. That's a nice spot to be a buyer. Now, one of the things I'll tell you is that that candlestick shape right there is particularly bullish. What's bullish about it? Well, the candle opened and closed at the same price, but it dipped down and then came back up before the close. So it's got a bottoming tail. So a bottoming tail candle like that is bullish, feeds right into the next candle, breaking a new high, squeezing through the high a day. And right there we go from about 560 all the way up to $7.40. Fantastic. And look at the increasing volume. Now, at the end of today's episode, I'll put a link to my my candlestick course where I teach you how to read candlestick charts. And in that course, I break down the anatomy of each of these individual candlestick shapes and what the sentiment is behind the shape. Because this candlestick shape here, to me, has kind of like a little bubble that's giving me an explanation of what it means. I already know what that means, but you may not. So if you're not familiar with the implicit meaning of a candlestick shape like this one, or perhaps like this one here, then I would definitely watch that episode when you finish this one. Here's another nice example. So you've got this rally up, one red candle. Now this one is green, so it's already showing that it's basing out, and then this next candle makes a new high, which is then the confirmation. The confirmation is the first candle to make a new high. Just being green is not enough. You need the next candle to make a new high, and then we rally back up. So you can see these are the patterns I trade every day. Rally up, pull back, rally higher, another pullback, and then another rally higher. And so you can keep trading these pullbacks, pullback, rise up, pullback, 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 pullback. You can keep trading this really as long as you want. The way I focus is I take a little bit of risk on my first couple trades, and once I have a profit cushion, I increase my risk. And then once I've had some really nice profit and I don't want to give it back, I start to decrease my risk. This is a little bit, subject to the individual day. On certain days, I'll continue to increase my risk all the way up to $200,000, $300,000, $400,000 of profit. And other days when the market's a little colder, I'm a little faster to take my profit off the table. Now, a variation of the bullish pullback pattern is what I'd call a micro pullback. A micro pullback is when the stock pops up on news, usually very quickly, pulls back just for a moment before surging higher. So this is a shorter pattern. You don't have as much time to think about it. The stock is super strong. But this is a pattern that I love trading because, in fact, the reason it works so well is because there's news, right? There's news, and the news is so strong, people don't want to wait. And next thing you know, this thing is squeezing up. This went from $3 a share to $6. It went up 100% in about 15 minutes. I made $55,000 on the day. That's incredible. Here's another stock, $175,000 on the day. This stock goes from $11 to $35 a share. That is unbelievable. This is huge. Micro pullback, micro pullback. Here's another one. A little dip, a pop up, a pullback, a little consolidation, and then it pulls away again. Micro pullback right here, another rally higher. This is actually UPXI, the same one that I was mentioning from earlier. So that was that first pop, and we had that first pullback right there, and then it continued to go higher as the day went on. And it's because it had really strong news. So this went from a low of $2 to over $11 a share. That's huge. Here's another one, popping up, a little pullback, pushing higher, a little pullback, pushing higher, a little pullback here. And look, it does not go back through the high a day. And that right there is your signal to stop trading it. And notice how the volume was lighter. So high volume and then declining volume on this false breakout. Time to take your foot off the gas and walk away. There will always be another trade around the corner. Here we go, $35,000 there, squeezing up, micro pullback, and then surging up all the way to $6 and $7 a share. And this is the stock hitting the high day momentum scanner. So why does that micro pullback work so well? Traders are watching a stock that has just hit the high day momentum scanner. Traders are watching big percentage gainers in general. The stock is obvious because it's one of the leading gainers in the market. The stock is currently moving quickly right now. A micro pullback is a moment of rest. It represents, or it presents as a dip. Essentially, a dip creates support when they hold, and then that entry is the lowest level of risk you could take to buy a strong stock. So a micro pullback is one of the fastest ways to get in something that's strong. And that's why micro pullbacks are so popular. That's why they work so well. And there are different variations of the micro pullback. Some of them are more defined, as the first example I showed you. Some of them are a little bit faster, as you'll see in some additional examples that that I'm about to share with you. But first, let me tell you 5 mistakes that I've seen a lot of beginner traders make when it comes to trading these pullbacks. So the first mistake is not trading an obvious stock. You're trading a stock that has a 100 million share float. You're trading a stock that's not one of the leading gainers. You're trading a stock that does not have above average volume. You're trading a stock that doesn't have news. You're trading a stock that's too cheap or too expensive. If you're not trading an obvious stock, you will not get clear and clean resolution. This is one of the most important things you can do to reduce your risk, is focus on trading the obvious stocks each day. Number 2 is trading when the MACD is negative. The MACD is a technical indicator. It's down here on this bottom pane. It's an acronym for Moving Average Convergence Divergence Indicator. When the MACD is positive, the blue line is above the signal, as you can see here. And right there it goes negative, which means anyone trading in here is asking to lose money. It's choppy. Here it goes back to positive right there, and it stays positive for this next rally up. So it's very important to understand that when the MACD is positive, you've got upside momentum and you've got more potential. And once that MACD goes negative, stocks typically enter periods of consolidation and they don't break out and they don't move cleanly. The third mistake is failing to read the volume. So this right here, the problem with this setup is that there was only a little bit of buying and there was a lot of selling. So if you bought down here to try to anticipate the first candle to make a new high, I mean, it never actually made a new high, but let's just say you got in early, you'd be failing to read the volume profile, which is that there's simply more selling than there is buying. The fourth mistake is chasing the correct entry. Sometimes these don't work, right? 30% of the time I lose. 70% of the time, roughly, I make money. So given that they don't always work, it's important to have the right entry. So the right entry was the first candle to make a new high. If you miss that and then you say, oh, I'll just get it in up here, it'll be okay. Well, then you're mismanaging your risk because now you're chasing the entry. Your initial entry down here with a stop loss at the low a day might have made sense with a target of a new high. Getting in up here with a stop way down there, now you need to sell up here. It just doesn't work anymore. So don't chase the right entry. Wait for the next setup to come around. And the fifth mistake is holding too long. So here are some common exit indicators. If there's large sell orders on the level 2, if there's a large topping tail, which is when you have a candle like this, but it has a large topping tail, or you have a high volume red candle, these are exit indicators I follow in my trading. Okay, so now I'm going to give you a pop quiz. All right, so what do we do here? We've got a stock that is currently on the scanners. It just squeezed up, it hit our scanners right here, and it's pulling back. Is this a place where we should be a buyer? Well, what is the volume telling us? The volume profile looks pretty good. High volume buying. We do have a topping tail back here, a little one right here, but if we get in right here, our max loss is down here, our target is a retest of the high, and the MACD has just gone positive. I think this is a trade that I can feel comfortable taking. And there you go, that's the resolution. Now, had that MACD been negative, had there been a big sell volume candle here, that would have changed things. But in this case right here, this was a buy and that was a good trade. Here's another one. All right, so is this a trade that we should take? Nice, strong rally up, little pullback here. Generally, the volume is much stronger on the green candles. This is a setup that I want to buy. So there we go. There's the resolution. First candle makes a new high. Even more volume comes in as it squeezes higher. What about here? Well, this has a little bit of a problem. The first thing is the higher volume selling. The MACD is open, but it's closing. And I just don't think we can get around that higher volume selling. In total, that's a lot of selling. It's not going to work. And in fact, it does not work. What about this one? Well, this is a little tricky. Again, there's a higher volume red candle there. It looks like it was really nice back here. It's a bummer I might have missed it, because right here, this doesn't look like a good trade. It's just going sideways. The MACD, it's negative. This is not a trade I should take. And in fact, it didn't work. What about this? This is a little tricky too. Looks like it had a nice move earlier, then kind of went sideways, started to pull away, popped up here. That was a nice pullback right there. That probably would have worked pretty well. The MACD was positive, but higher volume selling candle there, and now the MACD has gone negative. So right here, I can't take that trade. This might have been an okay trade here, and that might have been an okay trade there. But at this point, I can't trade it. What about this? The first thing you should see is the volume. Too much selling volume, it's not going to work. What about this one? Now this looks okay. Higher volume buying, yes, there's selling here, but in total, there's a lot more buying than there is selling. I could take this trade, and that works. And the MACD was open on that trade. Right here, MACD's open, light volume selling. This is a trade that I can take. Yes, you've got a little topping tail, still worth taking that trade based on the volume profile. I would just manage my risk and maybe trade slightly smaller size. So now I'm going to share with you a few of the trades I took to make $500,000 in 7 days. And these are trades that are straight from what I've just shared with you. So here was my biggest day, $278,000 in 1 day. So what are the stocks I traded? INM, LYRA. Look at the leading gainer on the day, LYRA, INM, all right, MINM. This one I actually lost on. And, well, fortunately, I kept the loss relatively tight. I was able to tolerate it. WETO at the time was on the top of the scanner. As the day went on, it went down the scanner. So it's a stock that squeezed up, but then dropped back down. But this is a stock right here, LYRA, that I did really well on. So it popped up initially, pulled back, squeezed up, first dip right there. That's the first one. Squeezes higher, pulls back. This ends up being a little bit of a false breakout. Now I have a note here that false breakouts are more likely when the stock is extended off its 9 exponential moving average, which is this gray trend line down here. So we were a little extended there. It popped up, it reversed down, comes back up again, drops back down, comes back up again, and now this is starting to represent a pulling away pattern. It does start to pull away. It dips just for a moment, and then it surges really quickly here, pulls back, and then pushes all the way to here. And in total, this is a move from about $4 a share to nearly $40. Wow. And then look at that MACD crossover. We get the MACD crossover, and what does that signal? That this first leg of the move is over. So the first leg of the move is over. Now we're pulling back. Will there be some opportunities here? Maybe, if the MACD can go back to positive. But as it turns out, it ends up just kind of going sideways and pulling back a bit. Now this is INM. This stock hits our scanners right here, 7 million shares of volume, a float of 500,000 shares, up 191%, squeezing up, pops up, pulls back, surges higher, dips down a little bit, and then suddenly here rips from about $4 all the way to $9.50. Unbelievable. So this is called a break of VWAP setup. The entry I'm going to show you on the next slide. So what sometimes happens here is you get this break of VWAP and then a micro pullback right after it. So that was a micro pullback. And in fact, this right here and this right here were also micro pullbacks. This is the pattern right there. It pops up, it dips down for a second, and then it pushes higher. Then it dips down for a second, then it pushes higher. And so that ended up being a really good trade for me. And it ended up going up over 300%. But this was basically, we were already on a day where we had incredible momentum because LYRA had made this huge squeeze. So I knew that the sentiment in the market was especially bullish. that traders were going to be a lot more aggressive. And I was going to be more aggressive too, because I already had a cushion of $69,000 on the day. So stepping up to the plate when INM was giving me this micro pullback, I had the cushion to take risk. And then all of a sudden it goes from 4 to 5. I'm holding my whole position and I'm adding. It goes up to 6, it goes up to 7, and I'm selling this up here and I'm up $2, $3 a share. It's a huge trade. That was actually one of my biggest winning trades of the whole year. Now, this is another setup that we had. This was on NIVF. So this is a different day. This stock's up 250%, 26 million shares of volume. We've got a big gap. It's a lower float stock. Relative volume, 346 times above average. By the way, going back to the relative volume of the previous two, LYRA was 2,300 times, INM 7,000 times, MINM 46,000 times. These are crazy high ratios of volume. What that tells us is that these are stocks that have been trading generally on light volume and that suddenly today have a catalyst. So here we get this rally up, micro pullback right there, and it pushes up higher to 650. That's a nice setup. Nice buying volume. MACD is open, higher volume as traders are buying that first pullback. And it's a nice move. It's a 10% squeeze in one candle. Here's another one. This one pops up initially, dips down and rallies back up. As it rallies back up, I got a micro pullback there and a micro pullback here, and I'm looking for that squeeze back through 8. Here I was up 116,000 on the day. Now RSLS at the moment was up 56%. I'd already traded TRAW, which was up 100%, SOAR, which is up 57%, and NIVF, which was up 170%. So I'd already traded these other stocks, and they were currently experiencing periods of consolidation where the MACD had crossed negative. So they were all on side charts waiting to see if maybe there'd be another opportunity. So in the meantime, I see another stock pop up that's on the fresh front side of the move. The MACD's open, it's got high volume, and I'm like, it's game time. I'm switching gears, I'm gonna trade this. So I'll jump around the market to trade what is moving and what is set up right now, as long as that stock has the potential to be one of the top leading gainers in the market. If it doesn't have that potential, then I've got to be a lot more careful. But as long as it has that potential, I'm going to feel good. Now, I will say, look, red days happen. I'm not immune to them. And I did have a red day on day 6. So day 6, I came in and unfortunately I went red right away and I was never able to recover to green. However, I kept the loss small. So the damage was relatively minimal. I mean, this grand scheme of things, this is tolerable. And as I said at the beginning of today's episode, I did a recap for that day there. So it was a red day, did my red day recap, uploaded it, and I put it all on the table. So it's not about never losing. It's about keeping the losses as small as possible. So keeping the losses small means adopting a mentality of breakout or bailout. What does that mean? It means when I get into a trade, I'm expecting it to work immediately. If I'm right and I've got the right entry here, it will work immediately. So if I get in and it's just nothing's happening, I got to get out and I got to cut my loss. And so if that happens, on several trades, then all of a sudden sentiment in the market is going to start to shift. Traders, including myself, are going to be like, oh, it's feeling pretty choppy today. I don't know. I better slow down. And then that hurts any additional setups that we might see. And then that becomes kind of this negative feedback loop where traders get increasingly cautious, shorts get increasingly confident, and we have to really ease off, take our foot off the gas until the next stock that has a really strong catalyst that overpowers even aggressive short sellers. So what I'm going to do for you here is I'm going to break down my strategy in 3 steps. So this is my day broken down into 3 steps. Starting number 1 with finding the leading gainer on scanners. So on this particular day, it was ATNF. All right, ATNF. But whatever is the leading gainer, those are the stocks I'm going to be paying close attention to at 7 a.m. at the top of the hour. And 7 a.m. is when I sit down to start trading because that's when most retail brokers come online. You want to start trading at 6 a.m.? Go for it. But the reality is you're going to see less volume in the market. A lot of brokers don't even allow their clients to trade before 7 a.m. So any setup that appears after 7 a.m. will have exponentially more volume than a setup that happens before 7 a.m. More volume means more liquidity and likely in this market, more volatility. So I wait till 7 a.m. So 7 a.m., step one, finding stocks on the scanner using my 5 pillars of stock selection. Step two, wait patiently for the pullback. Wait for it, and then strike. So that's what it's all about, being patient. A lot of trading is sitting and waiting. I sit and wait. Now, the good news is for me, I'm very productive while I'm waiting because I spend time working on classes like this, grabbing screenshots of all of the charts I've been trading, putting them into the slide deck. So I keep myself busy. You find one way or another to do it, but I don't want to overtrade. I don't want to punch the keys just for the sake of punching keys. I'd rather sit and be patient and wait for those A-quality setups. So then I can proceed to step three, which is execute. And on this day, I made $98,000 on the day. Unbelievable. Now, let me walk you through these important trading rules that I think a beginner trader should really adopt. Number one, so let me first say that as a beginner, it's especially important to put restrictions on your account for max position size and max loss. Those restrictions mean if you're down more than X amount, you can't take any more trades and you cannot take a position greater than X amount. This keeps you it's like having training wheels on, but training wheels keep you safe. And in my opinion, they're really important to have for a beginner. So the guardrails I think a beginner should follow. Number one, trade with small size each morning until you build a cushion of about a quarter of your daily goal. Once you've got a quarter of your daily goal, then you can go up to your regular share size, which is going to be standard. So each day you've got your small size and then you've got your full size position. You don't go one day trading 100 shares, the next day trading 10,000. You've got to be consistent every day. Number two, I walk away if I give back half my profit at any time during the day. Number three, I walk away if I hit my max loss. My max loss is whatever my average daily gain is. So if my average daily gain is $25,000, my max loss is $25,000. Number four, I do not come back after I've left. So after I leave for the day, I stop watching. This is very important. It's easy to keep watching stocks moving on your phone or whatever and come back and take more trades, and it's almost always a mistake. Number five, do not average down. Average down means adding to losing trades. It is not a good idea. Number six, if a voice says, I should probably stop, listen to that voice. It's very important to learn to listen to that instinct and walk away before it's too late. Because what usually happens is you're saying, I should probably walk away because you know you gave back a little profit, you're feeling a little frustrated, and if you keep trading from that place of frustration, things can spiral really quickly. Now, I'll be honest with you. In my trading today, I don't follow all of these rules to a T. I'm also not a beginner trader. As a beginner, it's really important to be super disciplined about following these rules. Once you gain more experience, you'll have the intuition to know the type of day that it makes sense to take a little bit more risk, the type of day it makes sense to walk away a little sooner. And so you'll be able to kind of feather, on a particular day, how closely you adhere to these guardrails. So early on, they should be very hard set rules. And as you gain more experience, they can become a little bit more open to interpretation as long as your metrics continue to support it. Number five, my post-trading routine. I import all my trades from the day and I analyze them. And I ask myself very honestly, what could I have done today to make more money? And what could I have done today to lose less? So when I'm analyzing my metrics, I have to have an honest assessment. Was my trading balanced? Was I making good decisions? Was I being too aggressive? Was I being too conservative? And, I have to be honest with myself because it's easy to say, I'm doing fine. I had a great day because I made money, but you took a lot of bad trades. So I try to have a very honest assessment. Am I making good decisions? And what could I have done today to do better? There's no day that I look at my trading and I say I was perfect. Every day, even the day I made $278,000, I think to myself, man, I wish I'd held that first trade a little longer. Or, I wish that I had bought a bit more size. I should have been or could have been a little bit more aggressive. And that's okay. In fact, I think there's something really exciting about this because even after all my years of experience, I still feel this excitement that I could get a little bit better. And so I'm driven to keep showing up and to try to continue to improve my trading. But your most valuable asset is your data. This is what's telling you what you're doing right now that's working, what you should double down on, what you've got to lean into, and what you've got to cut out entirely. For me, I learned I had to stop trading in the afternoon. Maybe it was decision fatigue, whatever it was. I wasn't making money, and I said, that's enough. I got to stop that. I got to find other things to do in the afternoon that can give me a sense of productivity. So if that means making episodes for those of you guys here on YouTube, that's a better use of my time. And it might not seem that way to you, but it actually is, and my data supports it. Now, I show up every single day because these past 7 days, I increased my year-to-date profit by 25%. I went from $2 million of profit on the year to $2.5 million in just 7 days. I had no idea that, within 10 days, I would have a $175,000 green day and then a $275,000 green day. And then, just on our REBN, another $115,000. So this day that once I import is going to come up to right here. I have no way of knowing what's going to happen in the market tomorrow, but I can control how I treat trading, and I treat it like a business. I show up every single day, rain or shine. I'm just like the mailman. I show up every day to trade. And on some days, I might not get as much for it. Maybe I catch a red day, whatever. I think, I guess I could have just slept in today. But there's no sense in really saying that, because you've got to show up every day. Over the course of the last 9 months, I've had only about 8 red days. Maybe it's 9. So I'm averaging right now, so far only 2 red days on the year. So we're 6 months into the year. I only have 2 red days, but a few red days back in November and September. So yeah, coming up on 9 months, there's probably about 8 red days, which I think is pretty good. And my hope this year is to keep the red days as few and far between, to know and to take my foot off the gas. And then when I'm seeing good action, to put my, pedal to the metal, size up, be aggressive, and try to squeeze as much as I can out of the market, because we have windows of opportunity. And right now it feels like the window is open. So if you're in a place where you're ready to learn more, I really hope you download the PDFs that I made available for you guys. I really hope you check out this full-length training on how to read candlestick charts, because that's a great place to get started if you're really wanting to learn more about how to start trading. I'll put another full-length episode there. And I'll remind you guys, as always, trading is risky. My results aren't typical, so please manage your risk and practice in the simulator before putting real money on the line.